BETR just reported a $70 million net loss. That's the headline. That's what everyone saw. And if you own this stock, I completely understand why that number shook you. Here's the thing. That number is almost completely misleading. And if you walked away from this earnings report thinking the business is deteriorating, I'm going to show you today exactly why that's the wrong read. I already did a full breakdown on why I own BETR. That video is linked below. Today is specifically about the Q1 2026 numbers, what they mean for the profitability timeline, and one thing the CEO said on the earnings call that most people completely glossed over. Here's what we're covering. First, why the net loss is the wrong number to watch and what the right number actually shows. Second, why the Q2 guidance revision had nothing to do with the business. Third, the most forward-looking data point in this entire earnings report. And fourth, the real bear case and what I'm personally watching. By the end of this video, you'll know exactly where BETR stands on the path to profitability, and why the CEO's exact words from this call are the most important thing any BETR investor needs to hear right now. There are two numbers in this earnings report. One of them is the right one to watch. BETR reported a net loss of $70 million. That's wider than last year's $50 million loss. That's the number that got the headlines. But there's a second number, adjusted EBITDA loss, $18.8 million. That's nearly half of last year's $36 million loss. Same quarter, same company, two completely different stories. So which one actually matters? And why did the net loss widen at all? Here's the accounting bridge that almost nobody explained clearly. BETR is selling its Birmingham banking operations in the UK. When you wind down a business division, accounting rules require you to take a write-down immediately. That added $21 million to their net loss this quarter. It's a one-time non-cash charge. It doesn't affect how the mortgage platform performs. Think of it like owning a rental property. Your rental income is growing every month. Your maintenance costs are shrinking, but your accountant tells you this was a terrible quarter because you demolished an old worthless shed in the backyard and took the write-off. That's the shed getting demolished. The house is completely fine. On top of that, BETR paid their employees $23.8 million in stock-based compensation, way up from $4 million last year, also non-cash, also hits net income on paper. Also not real cash going out the door. Strip those two items out along with a few smaller adjustments, and the net loss that widened to $70 million becomes an adjusted EBITDA loss of $18.8 million, improving by 48% year over year. The headline was reading the wrong line, and now you know why. Now let me show you what the business actually did this quarter. Revenue $47.5 million, up 52% year over year. Loan volume $1.645 billion, up 89% from the same quarter last year. And they didn't just hit guidance, they beat the high end of their own guidance by $95 million. The CFO said it directly on the call, quote, revenue grew 52% year over year while expenses grew only 27%, demonstrating real operating leverage, end quote. Revenue growing twice as fast as costs in a brutal rate environment. That's a business that's working. But here's the chart I really want you to look at, because this is the entire thesis in one image. This is BETR's adjusted EBITDA loss over the last 5 quarters, heading towards zero. A year ago, Q1 of 2025, negative $36 million. Then negative 23, 22. In Q1 of 2026, negative $18.8 million. Q2 guidance, negative $13 million. Q3 target, 0. This is a company trending toward profitability in a straight line, right through one of the most difficult mortgage rate environments in years. That's what the adjusted numbers show. That's the story underneath the headline. But here's what I know you're wondering. If the business is improving this consistently, why did they cut Q2 guidance? The answer has nothing to do with BETR's business model. In late February of 2026, the Iran war broke out. The Strait of Hormuz, the passage that carries roughly 14 million barrels of oil per day, was effectively closed to normal shipping. Oil prices went from about $60 a barrel to a peak of $117 a barrel. In a matter of weeks, when oil spikes like that, inflation expectations shoot up. When inflation goes up, the Federal Reserve can't cut rates. The market went from pricing in 3 rate cuts for 2026 to pricing in 0. Here's how that affects BETR specifically, and it affects them multiple ways. Mortgage rates went from 5.98% in late February, a near 3-year low, to over 6.5% on the BETR platform in weeks. When rates spike, 2 things happen. First, fewer people want to buy a home because the monthly payment just jumped. Second, and this one is even bigger for BETR, Nobody wants to refinance their existing mortgage into a higher rate. BETR's demand didn't disappear. It got frozen. And that distinction, frozen, not destroyed, is what changes everything about how to read this guidance revision. Now here's the part one really want you to pay attention to. This is the most forward-looking data point in the entire earnings report, and most people who only read the headline completely missed it. In April of 2026, BETR's biggest partner saw its daily pre-approval volume double, from $100 million a day to $200 million a day, in 1 month. Think about it this way. BETR's refinancing pipeline is like a nightclub. The line outside was exploding. $200 million a day in people who are pre-approved and ready to walk in. Then the Federal Reserve raised the cover charge mortgage rates because of the Iran war inflation spike. Now all those people are standing on the sidewalk. They haven't gone home. They haven't found a different club. They are waiting for the cover charge to drop. CEO Vishal Garg said this on the call. These are his exact words. Quote, "This is a huge reservoir of pent-up customer demand that while it may hesitate to lock and fund immediately now due to uncertainty in the Middle East and elevated rates, it will unlock into massive volume and revenue growth once things settle down." End quote. He called it a, quote, coiled spring. And then he said this, "You're going to see some bumper months as we convert all those customers who are effectively on a wait list to lock when rates come back down." End quote. Bumper months, I believe him. Here's exactly why. Traditional mortgage lenders face a real problem when demand surges. They have to hire more loan officers, more processors, more underwriters. Their costs scale linearly with volume. BETR built something completely different. The CEO described it on the call. Quote, "Betsy loan officer, Betsy loan processor, Betsy loan underwriter." End quote. Their AI platform handles all three functions simultaneously. Think of a highway with human toll collectors. Traffic doubles, you need twice as many people. BETR installed an EZ Pass scanner. When those doors open and all that pent-up demand floods in, the software handles the surge. No linear hiring required. That's why revenue is already growing 52% while expenses only grew 27%. When volume surges, that gap gets wider, not smaller. But there's a second revenue story happening right now that most people also missed. While BETR waits for rates to normalize, something else is driving revenue. Something that explains a very specific number. Revenue is growing 15% sequentially, even though loan volume is basically flat. How does that happen? The answer is HELOCs, home equity lines of credit, and the margin math here should genuinely surprise you. A traditional refinance mortgage has an average balance around $350,000. It earns BETR about 2.5 points in gain on sale margin. That works out to about $8,750 per loan. A HELOC, average balance around $100,000, earns 6 to 7 points. Call it 6.5. That works out to about $6,500 per loan, nearly the same revenue per loan, at 1/3 the balance, with dramatically better margins. In Q1, HELOCs were 12% of loan volume. By Q2, they're projected to hit 19%. That product mix shift, not volume growth, drives the 15% sequential revenue jump. Rate headwinds kept volume flat. The mix did the work. This is the part of the story the headlines didn't explain. Now I'm not going to pretend there's no risk here, because there is, and I think it's important to say that directly. The balance sheet is thin. Stockholders' equity has eroded to $8.6 million, down from $37 million just 3 months earlier. Total debt sits at $710.8 million. That's a lot of leverage for a company still burning cash. CEO Garg said something in the unscripted Q&A portion of the call that I want you to hear. Quote, "We're going to have to cut costs deeper," end quote. He said it plainly. If rates stay elevated longer than expected, the cost cuts get more aggressive. And that raises a real question about whether they slow down the AI development the entire thesis depends on. There's one more thing I noticed when reading through the actual filings. I want to be transparent about this. In Q2 of 2025, management was explicitly reporting Tinman AI platform contribution margins at 40%. Specific numbers, specific revenue per loan. Those metrics completely disappeared from Q1 2026 reporting. At the same time, they quietly reclassified some human-led loan volume into the platform channel, which inflated their AI growth headline figure. I'm not saying anything fraudulent happened here, but when a company stops reporting its strongest metrics and redefines a category, that's a flag. I'm watching this very closely going into Q2. The strongest version of the bear case is this. BETR is racing against the macro clock it cannot control. and the balance sheet has limited runway if the Iran situation stays elevated through year end. That's the real risk. Here's why I'm still holding. I own 1,700 shares of BETR at a cost basis of $25.69, a little over $43,000 total. Here's something that tells you exactly where my conviction level is. I run covered calls on almost every stock I own. I'm not doing it on BETR. I don't want to cap my upside. That is a deliberate decision, not an oversight. The two analysts who cover BETR right now have price targets of $40 and $53. On a stock trading at $25, the lower target implies 60% upside from here, the higher implies 110%. Do I know for certain rates normalize before year end? No. Do I know whether the Iran situation resolves on BETR's timeline? No. What I do know is this. The adjusted EBITDA loss has been cut nearly in half in 1 year, revenue is up 52%, loan volume is up 89%. Right now, $200 million a day in pre-approved customers are sitting in BETR's pipeline, waiting for the cover charge to drop, and management just reaffirmed EBITDA break-even by the end of Q3. Before this video, you might have seen that headline, net loss widens to $70 million, and assumed the business was falling apart. Now you know why that was the wrong number to read, and what the data actually shows about where this company is heading. I'm holding. I'm watching Q2 closely for those tin-min margin disclosures, and if rates normalize before year end, I think the CEO's bumper months comment will turn out to be the most accurate prediction from this entire earnings call. As always, do your own research. This is what I'm doing with my money.